Hello, welcome. Welcome to week 8. Welcome to chapter 7. Welcome to new current asset for you, and work with an old familiar current asset for you. So chapter 7 is about accounting for receivables, and we're going to be first talking about an old friend, accounts receivable, that you've seen and worked with probably since close to chapter 2. I think about that time that concept was introduced to you. To remind you, accounts receivable are a current asset. They're used to make credit sales to customers. They're a gentle person's agreement. There's no contract. There are perhaps terms of the sale written, but they're non-interest bearing, short-term, 30, 60, 90-day transactions. You expect the customer to send you a check. We found out about discounts on receivables so that if they pay us quickly, we will take even less money. And now we're going to talk about what if some people do not pay us at all. So that's the element of focus in chapter 7. Is what if the customers don't pay us at all. So chapter 7 begins on page 360, and it talks to you about receivables. It reminds you that businesses use receivables because to make credit sales, because they can make more sales. It increases sales. People will buy from the convenience of credit, and therefore the company will make more sales. For commercial sales between commercial entities, that's probably the only way the sale would be made, because these are made by telephone, or a sales representative comes from time to time, or a person comes and stocks the shelves, and then an invoice is sent, and the sale is made. And so if it weren't made on credit, wouldn't be made at all, because they'd have to pay in cash. And you and I see delivery trucks show up at market stores and places where Costco, where huge transport trucks show up and unload all of that equipment, all of those sales, and they're coming from different vendors, but they're all being delivered to that one Costco, and so or to that Costco warehouse. And so those credit sales allow for more sales to be made. Increased number of sales are made because they can be made on credit, and then the invoice can be sent and the check can be returned, and the electronic transfer nowadays at our bank can be exchanged, and those are all set up for credit sales. So as we talk here about credit sales, I want you to have an idea, a good reminder of why these sales are used and how credit sales work. Now, there's an opening introduction, like I said, in this chapter that says you can have cash sales or you can have credit sales. On page 362 to 365, they introduce to you what we call the allowance method of accounting for credit sales. And the idea here is that you don't know which of these credit sales are going to default, but you can be pretty well assured that some of them are going to default. Not everyone is going to pay you. You might not know exactly who's not going to pay you. You might not know exactly how much they're not going to pay you, but you can be certain that some customers are not going to pay you. Therefore, you need to make these sales, you need to make the collections, give the discounts. You can do all of that, but at the end of the accounting period, you have to accept the fact that some people are not going to pay, and for good matching, I need to match the expense of these bad debts that are going to happen against the sales that were made this period. So for good matching, for a more reliable number of net income, you have to make an adjusting entry for bad debt expense or uncollectible account expense, some name like that, that indicates some of these customers are not going to pay me. Now, the way that accountants do that is called the allowance method. And we create a new account for you this period, a couple of them actually. The first one we're going to introduce you to is the allowance for doubtful accounts. The allowance for doubtful accounts is a contra asset, runs contrary to the normal assets, therefore it has a credit balance. It's used to reduce the amount of accounts receivable to the equivalent of the cash you expect to receive. So you're going to have a net realizable value on the balance sheet that says this is how much cash we actually expect to receive from our accounts receivable. So we will have there are a number of terms here I want to remind you. The net realizable value is one of them. The cash equivalency value is another one. The face value is another one. And all of these that have contra accounts, all of these permanent accounts that have contra accounts, we call those the book value of the account, what's remaining on the books that we're going to actually expect to receive. The book value is the cash equivalency value. We're trying to get the book value to represent to readers of the financial statement, this is how much cash will actually be exchanged for this asset, so that we're always trying to get these to cash equivalency values. Now, since the exact amount of the loss can never be known, we have to make an estimate. So if you'll remember from some of the early chapters, we said that accountants frequently have to make estimates. We have to estimate how much is going to be left on the book value of that asset after it's depreciated. We have to estimate how much will be collected in these accounts receivable. So we have two estimation methods, and those are shown on pages 368 to 370. So 368 to 370. And just before I go there, I want to point out a couple of demonstrations in the book, that I want you to know. One is right on page 362. You'll see how the accounts receivable are presented. The accounts receivable less the allowance for the net realizable value of accounts receivable. I want you to stop and look at that box there at the top of page 362 and say, okay, that's how that has to look. And I'm going to show that to you again when I get to the balance sheets. Now, they go through a number of transactions, how to recognize the revenue. We've done that a number of times. Debit accounts receivable, credit sales, record the sale that the customer made. The collection, debit the cash, credit the accounts receivable, because they've paid you the cash now and the cash is going up and the accounts receivable is going down. When you look at those two transactions side by side as if they were fractions, you can see that the accounts receivable cancel themselves out, and in essence you have a sale for cash. It's just that you extended them credit for a while, so for a while you had this receivable. But overall what you wanted to accomplish was to make a sale and collect cash, and you used accounts receivable as the convenience during the time until they could pay the invoice. So that received the collections. And then in event 3, it shows you the adjusting entry for the bad debt expense. So we have a debit to a new expense account for you called uncollectible account expense, and a credit to the allowance for doubtful accounts. So that's the new adjusting entry. It starts on page 363 and ends on page 364. And when I ask you, please write down these page numbers and look back at these examples, that's the new example for this chapter. So this is where I want one of those post-it pads or one of those little arrows that hangs out the end of your book and says, look at this one, or a dog ear up on the top of where the page at the top is turned back so you can get to it easily. That's the new adjusting entry. Debit to uncollectible account expense. Sometimes you'll see it says bad debt expense. and then allowance to the doubtful accounts. The one is an expense account, shows up in the expenses in the income statement, temporary account, closed at year end to retained earnings. The other one is a permanent account. It's a contra to the asset accounts receivable, and it's used to drive down the accounts receivable to its cash equivalency value. So we're using it to credit. It reduces the accounts receivable down to the net realizable value, how much cash you really expect to collect on those accounts receivable. And then it shows you again how to present it in the balance sheet. And then on page 365, in the middle, the balance sheet is the middle financial statement, and it shows you what it looks like there again. Please stop and take time to look at those pictures. Pictures are our friends too. Sometimes a picture is worth 1,000 words, so if you just take time to look at the picture in the box, you can learn a great deal about how this is going to be presented. Now, what I want to stop and do for a minute here is to go to the methods that we use for that. Now, in the adjusting entry that they have here on page 364 for $75, they just said, let's assume that. But later in the chapter on pages 368 and through to 370, you'll find that there are two methods. One is the percentage of revenue method. Now, the percentage of revenue says, I have this projected loss because I made these credit sales. Now, it's only the credit sales that you can have losses on. You can't have losses on any cash sales because you've already collected the money on that. You're not going to lose any money. So what you are looking for is the percentage of credit sales. Now, sometimes a problem may tell you the credit sales, and sometimes it may require you to analyze accounts receivable to see how much were the credit sales. Remember, the credit sales were a debit to accounts receivable. So you'll go and look at the debits that came into accounts receivable, and you say those were our credit sales. You might have to add some together. You might have to do a math equation that says if this was the beginning balance and those were the credits, then this was the ending balance, then how much was the debit? And so you can solve for the debit. So there might be a number of ways you have to get to credit sales. But you always want to get to credit sales. Hopefully it'll be given to you in problems. Most likely you'll have to go through and analyze the accounts receivable and find the debits to account receivable and say those would be the credit sales because all the credit sales were debited to accounts receivable. And they want to use a percentage of all those debits. So if the credit sales, if they estimate that they lose 2% of all credit sales, then you would take the total credit sales times 2%, which is 0.02, and you would get your adjusting entry amount. So you just multiply the credit sales times the estimated percentage of loss, and that'll give you your adjusting entry for percentage of credit sales method. Very straightforward, emphasizes the relationship on the income statement. Because I made these credit sales, I gave that credit policy, and I have created this loss for myself. And I have to estimate how much that loss is every year to match that loss against the revenues that came in for the credit sales. So therefore, I'm emphasizing the income statement relationship by using the percentage of credit sales method. Now, the second method that's available is called the percentage of receivables. And what it says is it emphasizes the balance sheet relationship, because it says, because I have these receivables that have not been paid off and they're getting older and older on me, and I'm not able to collect them, and my collections policy is not working, then I have to have this bad debt expense, this uncollectible account expense, as a percentage of the receivables that are outstanding. So I'm going to ask you to write down or notice page 370 and 370 to page 372. So on page 370, and it's actually on page 371 where I want you to look, at Exhibit 7.3. Exhibit 7.3, you've got all the customers' names there, from A to Z. This one happens to go from Davis to Zachary. So there's all of those customers in that exhibit, and the total amount that they owe you, and the amount that's current, and then the number of days past due. So they spread out the balances by the number of days past due. So you've got 0 to 30, 31 to 60, to 90, and over 90 days. So we've got 4 categories there. Now it should make sense to you, I hope, that there's a higher probability that the people who have owed us already for 90 days and haven't paid us, they're more highly likely to not pay us than the people who everything is current. So we're going to assign a higher probability of loss in making our estimate. We're going to assign a higher probability of loss to the older accounts and a lower probability of loss to the new accounts. So the first thing we do is age these accounts to see how much money is in each category of age of older accounts. Then in Exhibit 7.4, when we look at that, it's got the amounts receivable, and if you look up above, that it was a total of $56,000 in accounts receivable, and $26,500 was in the current, and then $11,700 was in the 30-day category, and then $13,001, and then $3,000, and then $1,700 is in the 90 days. So when we look at this, we've got the accounts receivable listed by the total amount that is due in each one of those categories. Now next is the probability of loss. So we're going to weight that amount of money that's in that category by its probability of loss. So notice that it's at 1% in the more current, and it's all the way to 50% in the older accounts. So now since we're going to weight them, that means we're going to multiply them. So we're going to multiply 26,500 by 1%, but we're going to multiply 1,700 by 50%. And so then we get a category of the required amount that's due. So we've got 265, 585, 1310, 750, and 850, for a total of $3,760 that we need in our allowance for doubtful accounts. So whatever we have right now in our doubtful accounts, we have to increase it up to a credit balance of $3,760. So when we look at our allowance for doubtful accounts, down below they tell us that it has $500 in it right now. That's all that's left in our allowance for doubtful accounts is $500. So I have to bring that credit $500 up to $3,760. I wish I had a T account here to draw it for you, you know me and my T accounts. So I would have a T account with a credit balance of $500 and a required balance at the bottom of $3,750. And then I would tell you, how much do I have to put in there? And I have to put in there the difference between those two. So I'm going to say that that's $3,260. And that would be the amount of my adjusting entries if I was using the allowance method. Now remember that if I was using the aging of accounts, percentage of receivables method, I've aged these receivables, and that's how much I need to put in there. Now I'm going to extend the example in the book just a little bit. If I had a debit balance of $500 and I needed to move it up to a credit balance of $500, I'd have to move it out of the debit through zero and over to a plus $3,760. So I would have to add the $500 and the $3,760 because I'd have to compensate for the debit balance, the first $500, and then I'd have to add the $3,760, so I'd have to put in $4,260 as my adjusting entry to cover the debit balance, take it through the number through zero, and then up to a credit balance of 3760. So keep the percentage of receivables method in mind. It's different. It works differently than the other method. It's emphasizing the balance sheet approach to uncollectible account expense, and it's saying it's something about how I'm managing my receivables rather than how I'm managing my credit policy. The other one was about my credit policy. This one is about receivables. This is another decision that management gets to make. Management needs to say which is most informative and tell the accountant why, and then the accountant notes that and uses the method that the management wants used. And management would make the determination which of these methods is best. Now I have to tell you, most often they do consult the accountant and say, which do you think is most appropriate for what we're doing? And they talk that through, but ultimately it's management's decision. So on this page 371, you see the adjusting entry at the bottom. The adjusting entry is exactly the same as the other adjusting entry. It's just how we calculated the amount of the adjusting entry that's different. Now, in both of these cases that they present, I want to encourage you to read all the way through these methods, because they talk in more depth about the differences that I have discussed, and talking about how in the matching of this expense with the revenues, the asset method does one thing, emphasizes one thing, and the revenue method, the income statement method, emphasizes something else. So it's important for you to understand those nuances of how that's done. Now then, in the chapter, they present to you the concept that it's possible that you might have to write off some of these accounts, that somebody might not pay anything. And so if you have to write it off, you always write it off to the allowance. So the allowance is set up there. The allowance for doubtful accounts is set up as a contra asset. So when John Jones doesn't pay and John Jones owes you $500, you're going to debit the allowance and credit John Jones accounts receivable. Or you're going to accounts receivable John Jones, however you want to think about that. But the credit is going to go to the accounts receivable. Now, because the asset and the contra asset are being subtracted from one another, when you change their balances by exactly the same amount, the cash equivalency value does not change. The face value, the book value does not change. Both sides of that equation are going down by $500. So if you subtract 500 from both sides of an equation, the result of the equation doesn't change. It's lower. The line is lower, but the net result is the same. So that's the reason that accountants have us use, that the AICPA has us use the allowance method, because the cash equivalency value, the net realizable value, does not change when you have a write-off. The net realizable value stays the same. It's just the amount that's in accounts receivable and the amount that's in the allowance that go down, but they both go down by the same amount. Now, so all write-offs, every time you determine that you have to write this account off, it's no longer a viable account, you always debit the allowance and credit the account receivable, make the allowance go down and the account receivable go down, and you use the subsidiary ledger for John Jones so that he's the one that's not going down, that's not going to pay us anymore. Now time passes and in walks John Jones, and he says, you know, I'm here, I have money now, and I want to pay you off. So he comes back in and says, I want to pay my obligation to you. And when he does that, that's a recovery. And I want to show you the recoveries are on page 366 and 367. And I want to walk you through those events. So the first one on the top of page 366 is that you have a write-off, and that's the one I just talked to you about, and John Jones' account gets written off. You can then see the proof right below that of how the net realizable value of accounts receivable doesn't change. That's on page 366. And then you continue to have your normal transactions. You make sales and you collect accounts receivable, and all of that happens. But then John Jones comes back in on page 367 and he says, I want to pay my account off to you. Well, you've already written his account off. So this is one of those two-step journal entries. So as you look at that, the recovery of the accounts receivable is in event on 367, and then the recovery of the uncollectible is at the bottom on page 368. So first you reestablish the account receivable and reestablish the amount that's in the allowance. That's the first entry on page 367, debiting accounts receivable, crediting the allowance, making them both go back up. And then the second one is the recovery, and you debit cash and credit accounts receivable and establish that John Jones came in and paid that account off and give him credit for the in the subsidiary ledger that his account was paid off. So I want you to see that that's a two-part entry, and it's always one of those two-step entries where you first have to reestablish the accounts receivable because you've written it off and it's not there. So you don't have any place to put John's money until you reestablish the account. And then the second thing you do is take his collection and put the money into your account. So that covers uncollectible account expense and how we use the allowance method. Now, the book also has, I'm looking for it, direct write-off method. And the direct write-off method is not allowed under generally accepted accounting principles. And the only time that, it's on page 372. I'm sorry, I was looking, I should have marked it someplace. But the direct write-off method is when you don't use an allowance, and so you just write every account off to expense every time it happens. So it's a very random call on expense, poor matching, because you never know when it's going to happen, you never know how much, and net income would be going up and down if you had big losses one year and no losses the other year. Now the book says that the only time you can actually use direct write-off method is when the trained professional accountant says that these are immaterial. So management does have to make a call about materiality, that there just aren't enough collections, that this is worth it. Very small number of accounts receivable, very small amount, very infrequently used, would not materially influence a decision maker one way or another about the validity of the investment in our business. So those are the conditions for materiality, and but that can't just be made by someone who doesn't understand materiality. It has to be made by a manager and an accountant working together and deciding they're not going to use the allowance method. Most businesses that do any accounts receivable at all will use the allowance method, and any publicly traded company would have to, and any large company would have to, because if they're being audited, if their books are just being audited, the accountant would want to use the allowance method. So that concludes my comments about the allowance, and that's a current asset, accounts receivable, and the allowance method is that contra asset drops the accounts receivable balance down with that credit to its cash equivalency value. The next topic I want to talk to you about from Chapter 7 is notes. And we've had notes from an early time, and you've asked me several times now, where's that formula, rate times time times amount? And I've told it to you. I can't remember the page number where you first saw it, but it's all the way back in, I think, Chapter 2. So if it's not 2, it's 3. And the thing about it, that formula back then, it was embedded within the paragraphs. So you had to look at the paragraphs and read and find it. It was generally in italics, but it wasn't set apart in big blue letters or something. It is in this chapter. So now we're going to be looking at notes receivable. And notes receivable start at the bottom of page 373. And there's an example of a note, what it looks like. And I would challenge you to read the note and see if you can find a rate and the amount and the time and those conditions that we've been telling you. They're listed in the note. And then how you go about recording a loan and recording those transactions. And instead of an account receivable where you don't have any written agreements and maybe just a gentle person's agreement on conditions of credit, this one you actually have a note. It's signed by the borrower, it's held by the lender, it has terms and conditions to it. So the note in the example in the book has the amount is $15,000. It's issued on the date of 1/3/13. It's 6% interest per year, and the formula rate times time times amount equals interest is on page 375, and it's in a check yourself on page 378. So from now on you can't miss those. You can't say, I didn't see those. Those are sitting in the middle of the page with lots of white space around them, blue font, and so blue letters, and so you can see how that equation is used. To record this note, now we're talking about it from the lender's viewpoint. This is our asset, our current asset, and we're talking here in this part of the book about current assets. So this is going to be a debit to notes receivable and a credit to cash because we're giving the loan to someone. Now when we get about to Chapter 10, then we're going to be talking about liabilities and we'll be the borrower, and so then we'll have a payable. But right now in Chapter 7, we're the lender. We're loaning the money out to the person, and so they owe us the money. There's interest on either one of these, remember, but it's interest receivable when it's the current asset because they're going to have to pay us that interest sometimes, and it's interest income because we've made the loan and we have the income. So when we make the loan, it's debit to notes receivable to make notes receivable go up, that asset. It's either current or long-term. And then credit to cash because we have our cash going out. Now there's always an adjusting entry. We've seen this adjusting entry several times, and it's not unusual to us or peculiar. It's just getting more attention right now in this chapter. So it's going to be a debit to interest earned, to interest receivable for the amount of money that they owe us because it's an asset and they owe us that extra money. So a debit to interest receivable and a credit to interest earned because of the passage of time. They owe us this money. Now remember that adjusting entries are always made as of the last day of the accounting cycle, whether that's a fiscal year end or a calendar year end. Remember that these are always non-cash transactions. They never involve cash because they're unrealized gains and losses due to the passage of time. And so because we made this loan in November and the year end is in December, they owe us 2 months of interest. They owe us November and December's interest. So we're going to write an adjusting entry to debit interest receivable when they pay us and to credit interest earned because we've earned it during this year, which in the example happens to be 2013. But now, correspondingly, next year, we'll have 10 months over there when they actually pay us at the end of October when this comes due. So at the first journal entry, the adjusting entry at 12/31/13 is to multiply $15,000 times 0.06 times 2/12, because the interest rate is always per annum, so the time has to be per annum. You can only work in like denominations. So as we look at, time has to be in years. So then they get the interest here in the book at $150. So then it is my recollection, it is $150. And so then we start 2014. It gets to be the end of the end of the loan, which would be October 31st or November 1st of 2014, and they're going to pay us off. So they're going to pay us the $15,000 that they owe us. They're going to pay us the $150 that we recorded at the end of 2013. And now they're going to pay us what we've earned in 2014. And what we've earned in 2014 is $15,000 times 6% times 10/12, because the last 10 months were in 2014. Now, I do want to draw your attention that in the book they show two methods for recording that final entry. On page 376, they show two entries, one where you record the interest due, and then one where the second entry where you record the cash for the interest and principal, then the principal and the interest receivable. And so you do this in 2 steps. And that's one method that you can use. If you look across the page to 377, they show you an alternative method that you can use. Both are equally correct. Most people would probably use the method on 277 because it's more efficient. It's just one journal entry instead of 2. So now it's still the cash for the principal and interest, and it's the principal, and it's interest receivable and interest income there in that entry. Oh, pardon me, I'm very sorry. Instead of having one entry for the interest earned and then a second entry for the income. Now, it could be, too, that you would use the method over on page 376 if you weren't certain about when the person was going to make it, so you would just automatically do the interest earned at the end of the loan, and then whether they came in that day or the next day, it would be all set up to just have interest receivable and principal receivable. And so either of those methods is fine. They will get you to the same end. Don't forget to think about how these look on the financial statement. There's a nice depiction on page 377 about how the interest receivable, the asset, and the interest earned in the income statement, how they're depicted in the financial statements in those years. There's a good example of a trial balance there to show how you, of a balance sheet to show how those interest receivables are also shown with the current assets. Now, that's the presentation that they give in the book for notes receivable. And it's a fuller presentation. We've been working with these kind of just at an ease from chapters 1 to 5, and then I said at chapter 6 we really started going into depth in each one of these. How to value inventory, how to value cash, how to value these receivables. So we do that with each of these current assets in this chapter. The next one we're going to talk about are credit card sales. And companies do have to use credit card sales at times. And you've not had accounts receivable for credit cards before, so that's new to you with this chapter. Starts at the bottom of 378 and talks to you, shows you a credit card machine, which we probably all recognize, and then shows us the events here. That the first one, we sold goods to our customers on a credit card, and so we have our accounts receivable credit cards, and we have our sales revenue. Now notice in that entry at the top of page 379, they have the $50 expense for the credit card right in the initial entry. So they have accounts receivable credit card, and then and it was $1,000 in sales, but they only record that they're going to get $950, and then they charge themselves the $50 expense, and then they expect to collect $1,000 from the accounts receivable, but they show the sales revenue. They made $1,000 in sales, but they're not going to collect all that amount. So the accounts receivable are $950, the expense is $950. Both of those are debits and going up. First one's an asset, second one's an expense, but then the sales revenue is $1,000. So you acknowledge right away that you're not going to collect everything from the account receivable. You charge yourself the expense right at the time you make the transaction. And businesses record these daily. They know exactly how much they did on American Express and how much they did on Visa and how much they did on Discover Card. And when they make every one of those entries each day for the sales they made on that credit card, they charge themselves the percentage expense that they expect that the company's going to withhold right at that time. Next is the collection. Now the collection is the cash and the $950, and they'll get a check from Visa or an electronic transfer from American Express for $950 in cash. Their cash will go up, and their accounts receivable credit card will go down because they've collected the money. And those are quite easy transactions. They happen regularly because, again, credit sales make sales go up, and a lot of people do this sort of a transaction. Now what many of us don't realize is that when we use our debit card, there's an expense for the use of the debit card to the company as well, and so their debit card would work much the same way. That's the last presentation of an account that there is in the chapter. And so we've gone through accounts receivable, notes receivable, credit card sales receivable, interest receivable, new current assets with this chapter and how they're recorded. The next thing, though, that I want to turn your attention to is on page 379. And that starts the financial analyst and the ratios that we look at for accounts receivable. So notice it gives you a presentation on cost of credit card sales. You turn the page and it's got two new ratios for you. The chapter presents two new ratios for you. The first one, and actually it's one ratio that has two parts, and what we want to know ultimately is how many days do we have money tied up in these accounts receivable? How many days are we waiting for this money to come in? And if we think that the days are too long, it's taking too long to get the money recovered, then we will probably start raising that discount. The sales discount, if you'll pay us, we'll give you a bigger discount because we'd like to get our money back faster. If we find out that it's taking too long to get our credit cards from American Express, we might decide not to take American Express and to only take Visa because Visa pays us faster. So that's how these ratios are used to know how many days we're waiting for our money. So the first one is sales divided by accounts receivable, and that's the average number of days that our money is outstanding. So you'll find that when you do that equation, accounts receivable divided by sales, we're going to get something like 3.5. That's what the actual answer is in the book. The average number of days is 3.5 per year. Well, okay, that's the account receivable turnover, so it's turning over 3.5 times a year, but I want to know that in actual days. So yeah, that might be my average turnover is 3.5 per year, but how much is that? Well, I have to then divide, I have to use the 365 days to know how many that is per day. So the second one says 365 days divide by the average turnover. So when I look over here, 365 days divide by 3.5 times per year, that's 104 days. That's over 3 months that we're waiting to get our money back. So you can begin to see if you are waiting 104 days to get your money back, the example here at the back of the chapter, there would be a strong incentive to say that discount on sales is too low. We've got to raise that. It's taking way too long for those credit cards to pay us. We've got to look for the credit cards that pay more frequently. Those are the kinds of decisions that these numbers would drive. Another one might be if it's taking us 104 days to collect on average per year, then we've got to tighten up on our credit policy, or we've got to tighten up on our collections policy. Back to that focus on the asset accounts receivable and begin to say it's way too long. If you perhaps had been looking at percentage of sales method for your bad debt expense, and then you found out that it was taking 104 days to get your average collection, well, no wonder that wasn't giving you the right focus. You needed to focus on how long these accounts receivable were outstanding. So you could begin to see how this ratio triggers many thoughts in the mind of a manager and an accountant to begin to think about how can we get our money back faster. Money is the lifeblood of the business, so we've got to see how can we use credit for more sales and correspondingly get those sales paid for faster. So how can we get our money back in here faster? So that then brings us to the example of Target at the bottom of page 381 and the top of page 382, and some talks about Harley Davidson and about international, but looking that this accounts receivable turnover ratio has broad application in many businesses. The numbers might be different. If you were selling a Harley Davidson, if you were a Harley Davidson dealer and you were selling Harley Davidsons on credit, but people were paying you within 90 days, that would be a pretty good situation. I'm going to guess that most Harley Davidson dealers, if they're carrying their own paper, it's much longer than that. I'm guessing it's a note instead of an accounts receivable. But if I'm Target and people are paying using my Target credit card, and they're taking 104 days, I can't afford to carry them on that credit that long. I need it to be paid back faster. Well, that brings us to the end of the chapter and the end of these new current asset accounts for you, the end of these new calculations. I'm going to, in the Appendix E, introduce you to some more current assets, but for Chapter 7, those are the current assets that are covered. If you have any questions about these, I welcome you sending me emails. I welcome you coming by my office. If you are in the class, I welcome you coming into the class and raising your hand and listening. If you're in the online class and you don't quite understand this and you want to come to Monday's lecture and sort of listen to how I handle this in the class, you're welcome to do that. There's generally room, and if you want to visit on Wednesday, you're welcome to do that. There's generally room. So if we push out the students who are registered for the ground class, then I would have to ask you to bring in a chair or something, but for right now there is room and you're welcome to join us. So the way this is set up, I can invite you to the lecture because there are plenty of chairs in the lecture. We go to the lab Monday at noon, our second hour, so I couldn't invite you to that. But this next week I'm going to be holding, the week of this class, I'm going to be holding a lab for the online class Wednesday. and I believe it's Wednesday 1 to 2 is my time. So you are welcome to come into the lab Wednesday 1 to 2, and I'll help you then. You can tell from this that I'm recording this before the week starts, but I'll send you some emails about that as well. So thank you for joining me for this YouTube video. Thank you for considering Chapter 7, and I'll see you around as we study more about current assets.